Okay, we're going to continue with our discussion of the investment environment, part two. So let's talk about investing plans themselves, right? Essentially, I think everybody realizes is that you have to have some kind of a plan. And one thing that I've learned over my many years on this planet is, a plan is not a plan unless it's written down. So we need to have a way or a mechanism to develop a well thought out plan that covers the basic money management tools and techniques, tries to avoid some of common mistakes, right? But we have to have some kind of plan. So over the next several slides here, we're going to be talking about some of the components of this plan. We'll talk about a policy statement, right? What is the actual plan? We'll talk about some taxes. We'll talk about how investment relates to your life cycle. So let's first start with how do you make this investment plan, right? So essentially we need to summarize your current situation. You need to record everything that you own, everything that you are contracted against, right? So we need to gather material, right? We need to know what are the assets that you own, right? We need to have some mechanism in which to record our spending and income habits. We need to have some stated investment horizons, right? This means that there may be more than one objective in your investing, right? Most of us will be saving for retirement. That's just one investment horizon. Maybe you're saving to buy a vacation home, these are all separate and distinct investment patterns and investment goals, if you will. So again, we have to understand what it is we're saving for. What's that time frame? We need to understand those goals, the financial objectives that we're going to use to get that piece. We need to understand our risk tolerance, right? We need to understand what is our actual investment philosophy. How do we feel about that? We need to create some selection guidelines. And if you have guidelines, it keeps you from straying, if you will, towards things that you might not normally have thought about. But again, if you haven't normally thought about them, maybe they just don't fit in your plan. So we need to have some guidelines that we put in place. And again, we have to have some mechanism to monitor excuse me. So the next step we'll talk about is to discuss personal taxes. Again, not a topic everybody likes to discuss, obviously. But obviously the basic sources, federal, state, and local. There's income taxes, sales taxes, property taxes. There are three basic types of income that what we would refer to as being ordinary income, right? This is active income. This comes from working, wages, salaries, pensions, maybe your business. Portfolio income. This is what comes from investments. So we're talking about interest, dividends, capital gains. And then passive income comes from special kinds of investments. These are things like rents. So rents from real estate and royalties that could come from limited partnership investments. Currently in our tax system, we are taxed at what's referred to as a progressive tax rate. So what this means is, as your income rises, the tax on this later income is taxed at a higher rate. So rates go up as income goes up. Briefly talk about capital gains and losses. When you sell an asset for investment purposes, and or if you sell it in a business context and it's a plant and equipment, there is a taxation event that's created. So capital gains obviously is the amount by which the sale exceeds the original purchase price. We'll frequently refer to this to as the basis of the asset. So if you hold the asset for less than 1 year, the taxation is at your ordinary income tax rate. Capital assets that you hold for more than a year are either taxed at 0, 15, or 20%, depending on your income level. So again, if you're being taxed at a 39% tax bracket for your wage income, you're probably going to be taxed at 20% for capital assets long term. But if you held it for less than a year, and this is the critical part, if you hold it for less than a year, it's not going to be taxed at 20, it's going to be taxed at 39, which again you recognize is almost double. Capital losses obviously is when the price that you sell for is less than that basis price. You can use capital losses to offset capital gains, certainly. So at the end of the year, it's the net amount that you pay taxes on. But one of the other categories, if the capital losses exceed your capital gains, you can only deduct every year up to $3,000 to offset your ordinary wages. So again, I think we'll have an example here in a second. But the general idea here is the maximum total deduction from capital losses from your income is $3,000 per year. Now that also carries over into future years. And in fact, you can even carry it back a couple of years if it's a substantial loss. So here's an example. I have a $12,000 in capital losses, and their other income's $50,000. So this year they can deduct $3,000 from their ordinary income to determine what taxes they owe. And then they carry the remaining $9,000 to the next year. Now next year they earn $5,000 in capital gains. So they have $5,000 in gains, subtract the capital loss remaining of $9,000. They now have $4,000 in losses to recover. Of course, they have a maximum. They're only allowed to recover $3,000 or write off $3,000 a year. That means the remainder, the other $1,000, will be carried on to the next year. So if we're considering personal taxes, right, we have to do some tax planning. You have to understand the tax process, and it's not like it's something that you can really get away with, right? It's not something that you can say, hey, I want to invest this way because in 15 years this is going to be my tax bracket. You really don't know what that tax bracket's going to be. So as I'm thinking about this, I'm thinking, what tax will you have to pay when you get to retirement? Now this is changing as generations proceed. Older generations, my father, for instance, during retirement never paid taxes because all of his income came from Social Security, and he had a very small taxable account that never really amounted to, quite frankly, more than $4,000 or $5,000 a year. But my income is all going to come from my 401ks. That's where a majority of my income is going to come from. So I will pay taxes for the rest of my life as long as I'm receiving this 401k income and my retirement income from my personal investment accounts. So the taxes will change. So when many people in the past have said, when you get to retirement, taxes are going to be very low. Well, I think that's a very relative term. First of all, you don't know what the rate is going to be anyhow. But even when you get to that point, it's hard to say exactly how much you'll pay because some of your income may come from Social Security. Some may come from maybe some specialized kinds of retirement accounts called Roth accounts that there's no tax at retirement. But as I mentioned here, your tax advantage retirement plans, you're going to defer taxes now. But again, the key thing here is you are deferring it. That means later on you will have to pay taxes. So for most of us, taxes will be a way of life for the rest of our life. We'll continue to pay taxes. So again, just to keep in mind, it's not what you make, it's what you keep that's important. So we have to make sure we pay attention to what is the desired return after taxes, right? Because you need to get to a certain amount. The only amount that can get there is the stuff that you actually keep. So we need to look at after-tax returns as the number we need. The type of income you receive, obviously from investments, is very important. And of course, the timing of profit taking and loss recognition will also be very important as we move on and think about how we're going to invest and what our strategies will be. So there are several steps in the investment process, if you will. So you need to meet some prerequisites before you even think about investing. You have to make sure that we adequately provide for the necessities of life. You obviously have to be able to pay your current bills, and you need to have some form of an emergency fund. Something building so that when a rainy day comes, you have access and you don't have to go to your assets, your other assets, your investment assets, in order to compensate or pay for these rainy day events, right? You also have to make sure that you have adequate protection, right? You have to protect the things that you already have, right? You need to protect your house, your cars. You need to protect your income through forms of life insurance, through disability insurance, right? You need to have a base plan that is really very conservative and is looking at protection before we go to the offensive side and start looking for ways to gain in wealth. We then need to establish our goals, right? The four basic goals of everybody, right, is you want to get some retirement money. You need to figure out some ways maybe to enhance current income. We need to save for some major expenditures, and we need to shelter income from taxes as much as we possibly can. Once we have these goals, we need to have a written investment plan, right? We need to have target dates. We need to have risk tolerance understandings for each goal that we might have. And again, as I mentioned, you could have several goals, right? You want to save retirement. You want to save for a major expenditure, right? So those are two different goals that could require two total different investing strategies. You need to obviously then start to evaluate some investments. When we get to chapter 4, we'll start talking about some risk elements of that. We're going to select some suitable investments, right? We're going to have to do some research. We're going to have to make some selections of those actual assets. We're going to have to create this in a portfolio. Diversification is a concept we'll talk about that can help us maybe increase returns or decrease risks. Again, that's a chapter 5 kind of a topic. And then, of course, we have to manage this portfolio, right? We have to monitor and make sure that what we want to happen is happening, right? Or at least it's not moving in the wrong direction, we'll say. So next, let's think about what's referred to as your life cycle, right? When you're young, right, you're typically going to be able to take more risks. You're going to be a more growth-oriented type of an investor, right? You're going to be able to take some more speculative investments, right? You might be able to invest in some higher risk common stock investments. But when you're young, you have time to recover from the ups and downs of the market. And quite frankly, when the market goes down, and we'll discuss this in some later chapters, when the market goes down, that's actually a good thing, because if you're continually investing, as the market goes down, you buy things at cheaper and cheaper dollars. During the Middle Age, they refer to this as consolidation. We're going to start moving to maybe some slightly less risk investments. We want to have a balance between growth and income. And then once we get to retirement age, we're going to want to have a more income-oriented portfolio. Could be very conservative. It could have some low-risk income stocks, mutual funds, bonds, etc. But we change exactly how we view the world and how essentially what is changing is not our goal. Our goal is the same. What is changing is us. Our risk tolerance changes as we get older. So again, growth-oriented use stage, we're going to have higher potential growth, higher potential risk. Capital gains are going to be typically greater than what our current income levels would be. At middle age consolidation stage, we're getting family demands. Responsibility is going to be more important, right? Education, saving for retirement. We're going to move towards some maybe less risky investments, right? At the retirement stage, preservation of capital becomes our primary goal. So we're going to be much more conservative with how we invest. We may need to look at some alternative methods of income, right? We may need to find some ways to try to supplement our retirement income. So what are the types of investments at each stage, right? So in a growth stage, common stocks, options, maybe even futures could be potential investment tools. Middle age, low risk growth and income stocks, maybe some preferred stocks, some high grade bonds. At an income oriented stage, again, we want low risk income stocks, government bonds, good corporate bonds, right? Really what's changing here, again, it's us that's changing. But I would also hesitate or I would worry about this getting the impression to you that people should buy stocks, right? You shouldn't buy stocks. You shouldn't. All of these investments, with the exception of options and futures, all of these investments can be purchased in the form of a mutual fund. A mutual fund for an average middle income person is where their money should be invested. So what kind of income are we talking about when you can start thinking about buying common stocks? Personally, I've talked to some people and they're saying unless you have $250,000 that you can invest and not worry about, then you should be in mutual funds. So you need to have a fair amount of wealth before you should consider to individually invest in stocks and bonds. Mutual funds are much less expensive. They're, in the end, because of diversification, they're less risky. So it's a better mechanism for the average person to be able to create strategies that can be helpful for them in the end. So we'll off to the next part in a second.